This video will be very long, as it is a complete financial guide on how to conduct macroeconomic analysis on your own. We will learn many definitions and look at many technical topics and indicators. If you're not ready to watch this guide or don't have time at the moment, I suggest you leave and come back later, when you can commit to watching it, as the information you will receive is valuable and will help you make better investment decisions and develop as investors. Additionally, during this short seminar you will attend, I will be providing you with both the Greek terminology and the corresponding English terms, so you can also refer to international news. This is something very important to consider when conducting analyses. So, let's get started. Many times, the stock market is seen as a source of easy wealth. And at this point, I want to emphasize again that we are not judging any investment strategy. Putting all your money into one stock because you believe that this one stock will make you rich is also an investment strategy. The purpose of this guide is to show you the risks and potential dangers inherent in various investment strategies, so that you are more informed before making an investment decision, and not to define any strategy as right or wrong. Another strategy that is often chosen due to its seemingly low risk is investing in ETFs. With this investment, you buy a basket of stocks instead of individual stocks in order to achieve diversification in advance and consequently reduce the investment risk. ETFs may have a 10% increase per year, but what you might not know is that there are years with zero or negative returns. ETFs also present some additional disadvantages compared to stocks, which are beyond the scope of this video. For those of you who want to learn more, watch the related video, Stocks versus ETFs. Now, for those who stay and watch the video until the end, I will reveal an indicator that shows us whether we are in a bubble in the stock markets. Also, at the end of the video, I will analyze my investment strategy for the first half of 2025 and present a recommended portfolio diversification in stocks, bonds, and cryptocurrencies with examples, as well as the weight each sector should have in your portfolio. Here we see the graph of the S&P 500. What do you notice here? That there are entire decades with negative returns. More specifically, the S&P 500 took 2 years to reach the highs it had in August 1987. Then, to reach the highs it had during the dot-com bubble, it took from March 2000, and reached them again in May 2007. Naturally, as expected, the dot-com bubble led to the 2008 real estate bubble, the well-known housing bubble. So, what do we see? The S&P 500 to reach its 2007 highs again, which, as we said, were the highs of 2000. It took 6 years. Therefore, we observe that if someone had invested their money in the S&P 500 at the peak of the dot-com bubble, they wouldn't see a profit for a full 13 years. Also, many times you will hear analyses only about stocks and factors that affect their price. I have a related video titled, "What Makes a Stock Go Up?" However, the stock markets and the economy are like a living organism, and therefore, these reports are superficial. In other words, it is obviously important to know what makes a stock go up or down, but many times the fluctuations in a stock's price are not solely due to isolated indicators, but may be the result of a combination of factors, which may not be directly related to the stock markets. Below, we will see how macroeconomic data and geopolitical developments affect stocks. The year 2025 is expected to be a year full of challenges, but at the same time opportunities for the global economy, as markets try to adapt to a series of developments: the monetary policy of central banks, geopolitical instability, technological progress, and the unpredictable nature of the new president of the United States, Donald Trump. These developments are not particularly favorable for passive investing strategies. As Byron Rothschild used to say, buy when there's blood in the streets, even if it's your own. Also, as we have mentioned in a previous video, crises breed crises. Let's now take a look at central banks and interest rates. As we have said in many previous videos, you can check out the related playlist titled Stock Market. Central banks determine But what does monetary policy mean? In simple terms, it refers to the strategies and tools used by central banks to ensure low unemployment, inflation at the 2% target, and a stable national currency. In order to manage these three, they use three tools from their arsenal. The first is open market operations, where central banks engage in bond purchases to control the yield curve of bonds. Also, if they want to strengthen or weaken the national currency, they make corresponding purchases in the foreign exchange market. The second tool is lending interest rates. We hear that due to the increase in inflation, the European Central Bank and the Federal Reserve of the United States have started a cycle of raising interest rates. And then, when inflation fell back towards the 2% target, they began cutting interest rates. They started reducing interest rates in order to ensure that growth would not be affected. In the chart, we observe that the Fed's interest rate, due to inflation, peaked in 2023 to 2024 at 5.5% and still hasn't returned to pre-crisis levels. At this point, we should mention that the Fed's interest rate is also called the Fed's fund rate. In the chart here, we observe the development of inflation, which reacts positively to the rise in interest rates and de-escalates. We should emphasize at this point that high interest rates are not good for economic growth. The reason is simple and based on common sense. High interest rates mean a high cost of borrowing. When it is more expensive to borrow, it means that consumers have less disposable money for purchases, and businesses have less disposable money for investments, such as in upgrading machinery. When private consumption and private investments decrease, it leads to a reduction in GDP. Let me remind you that GDP is private consumption, plus investments, plus public spending, such as a new bridge, the expansion of the metro, or public employee salaries, plus net exports. The third tool is the reserve requirements, meaning what reserves in cash or government bonds systemic banks must hold. In this way, they also influence the flow of money and can control loan disbursements to consumers or businesses through cash requirements. The year 2025 is a critical crossroads that will determine growth in the USA and the European Union. The tariffs that President Donald Trump threatens to impose have led economic analysts to fear that it may lead to a resurgence of inflation. And the reason is simple. If a product is imported into the USA and costs $100, with tariffs of 25% that Trump will impose, it will reach the final consumer at $125. Let's remind at this point, as we have mentioned in previous videos, that inflation is the reduction of the consumer's purchasing power. In simpler terms, with the same amount of money, they buy fewer products. And you might say at this point, why should I care about the resurgence of inflation in the USA? I live in Greece. Yet it does matter to us, and I will explain why right away. A resurgence of inflation will lead the Federal Reserve in the USA to increase interest rates. An increase in interest rates in an economic system that has been addicted to cheap money for the last 25 years will lead to cracks and potentially result in an event like the collapse of Silicon Valley Bank in March 2023. Even worse, the United States might be led into an economic slowdown. A slowdown in the largest economy on the planet will affect all other economies, some to a greater extent and others to a lesser extent. It will also affect corporate profits, and the increase in interest rates will impact the valuation of stocks on the stock market board. Now, on the European front, the Eurozone is showing sluggish growth. Germany and France, the two largest economies, are flirting with recession, and the euro has weakened against the dollar. Although the markets were initially optimistic about interest rate cuts, the Federal Reserve remains cautious due to inflationary pressures, according to Brian Jacobson, chief economist at Enex Wealth Management. The tariff increases planned by President Trump could keep prices elevated for a longer period. This means that the Fed may keep interest rates high, or even consider new increases towards the end of the year. The latest labor market data confirm the strength of the American economy, but also the difficulty in reducing inflation. Non-farm payrolls increased by 143,000 in January, lower than economists' estimates of 175,000, while the unemployment rate fell to 4% from 4.1%. At the same time, wages increased faster than expected, which may boost inflationary pressures. Bond yields rose sharply on Friday following the release of the January jobs report. Despite the fact that the number of jobs added was lower than expected, investors increased their forecasts that interest rates will remain high for a longer period due to strong data from other sectors. The yield on 10-year U.S. Treasury bonds increased by 6 basis points, reaching 4.5%. The market that the Fed will not cut interest rates at the next March meeting, with the probability of them remaining unchanged reaching 91% on Friday, up from 84% the previous week. The probability that interest rates will remain unchanged at the Fed's May meeting increased to 70%, from 60% the previous week. The increase in jobs, which was lower than estimates, would typically lead to expectations of a rate cut. But the January report presented other signs of a strong economy that weaken expectations for an immediate rate cut. Bill Adams, chief economist at Comerica Bank, stated that the Fed will not see a reason to change its plans for interest rates due to the data from the jobs report. Wages increased by 4.1% compared to last year, above the expected rise of 3.8%, and unemployment fell to 4%, the lowest rate since May of the previous year. Revisions of the data for November and December increased the job numbers by 100,000, despite the fact that the number of new jobs for January was 27,000 fewer than estimates. Revisions of previous months suggest that the increase is 73,000 jobs, higher than expectations. Jason Pride, head of strategy and research at GleanMade, stated that the jobs report confirms the Fed's approach to delaying interest rate cuts. The Fed is expected to keep interest rates high at 5 to 5.5% for most of 2025, with possible cuts at the end of the year. If inflation subsides, the European Central Bank will delay interest rate cuts due to persistent inflation, keeping them close to 4%. The dollar is expected to maintain its strength due to the Fed's interest rate policies, while the euro will be pressured by low growth in the eurozone. The euro-dollar exchange rate might move towards 1.05 as investors seek safety in American assets. Therefore, the monetary policy of the Fed and the European Central Bank will play a decisive role. Despite expectations for interest rate cuts, central banks will proceed cautiously, depending on inflation data and the resilience of labor markets. If interest rates are reduced too quickly, there is a risk of inflation reappearing, while if they remain high, growth may slow down. Let's now look at macroeconomic indicators and growth. The year 2025 is expected to be a year with mixed challenges and opportunities. For the global economy, let's look at the 5 key macroeconomic indicators, what the estimates and forecasts are for 2025, which factors will affect them, so you know when you hear the news and what impacts they also have on economic growth. For each macroeconomic indicator, I will also mention the English terminology, so you can refer to the news if you wish. The macroeconomic indicators are Gross Domestic Product, Purchasing Managers Index, Consumer Price Index, and Producer Price Index. Consumer price and producers, such as the unemployment rate, retail sales figures, and other economic indicators. Let's now examine them one by one in detail. First of all, we have the gross domestic product, commonly known as GDP. GDP measures the total monetary value of all final goods and services produced within a country's borders over a specific time period and serves as a key indicator of economic health. In the United States, GDP growth is projected to be 2%, down from the estimated 2.7% in 2024, while in the European Union, we have an expected GDP growth of 0.9%, indicating slight expansion. In the EU, this shows a slight expansion. What factors will now influence the GDP growth rate? Initially, Trump's trade policies. The reintroduction of tariffs on imports from countries like China, Mexico, and Canada is expected to disrupt supply chains, increase production costs, and lead to retaliations, thus reducing GDP growth. Subsequently, ongoing geopolitical tensions, including trade conflicts and regional crises, contribute to economic uncertainty, reducing investments and trade. Furthermore, a strong dollar makes American exports more expensive for foreign buyers, potentially reducing the volume of exports and widening the also. Although the Federal Reserve of the United States has halted interest rate cuts due to the strong domestic economy, other central banks continue to lower interest rates and boost their economies, which may lead to capital inflows to the United States, further strengthening the dollar. The production of goods and services relies on energy from fossil fuels. Therefore, fluctuations in oil prices affect production costs and consumer spending. High prices increase transportation and production costs, leading to inflationary pressures, while low prices boost consumers' purchasing power. Geopolitical tensions, especially in the Middle East, affect the price of oil. The United States and the European Union both have a large trade deficit. An increasing trade deficit, where imports exceed exports, can burden the GDP, as net exports are a component of its calculation. Trump, in an effort to reduce the trade deficit, threatens to impose tariffs. However, this will backfire on him because those countries will impose corresponding tariffs on the U.S. The best thing he can do is to increase exports and repatriate industries to boost production. In the event of tariffs and a recession in the European Union, the strong dollar will affect U.S. exports. The combination of protectionist trade policies, geopolitical uncertainties, a strong dollar, and differing monetary policies from central banks creates challenges for maintaining strong economic growth in the U.S. and the EU. While the U.S. maintains moderate growth, the EU faces more significant obstacles due to weaker demand and external pressures. Next, let's take a look at the Purchasing Managers' Index. The PMI is an economic indicator derived from monthly surveys of private companies showing the current direction of economic trends in manufacturing and services. An index above 50 indicates growth, while below 50 shows contraction, which could potentially lead to a recession. In the United States, the services PMI decreased to 52.8 in January 2025, from 54 in December 2024, indicating a slowdown in expansion. A similar picture of slowdown is presented by the PMIs of the strong Eurozone countries, Germany and France. The region is facing economic challenges that may affect manufacturing and services. In 2025, increased tariffs raised the cost of raw materials, reducing production and the PMI. Additionally, political instability and trade tensions disrupt supply chains, negatively affecting the PMI. A strong dollar, as we mentioned earlier, makes exports less competitive, reducing new orders for manufacturers. The only positive, as we mentioned in the section on central banks and monetary policy, is that lower interest rates boost business investments because they make borrowing costs cheaper and consequently also strengthen the PMI. Pay close attention to how the price of oil will fluctuate. Increases in prices raise operating costs, reducing profit margins and production. Next, let's take a look at the Consumer Price Index and the Producer Price Index. But before we continue the analysis of these indices, let's look at a brief definition. The Consumer Price Index measures the average change over time in the prices paid by consumers or a basket of goods and services, reflecting inflation at the consumer level. We observe this in the bars of our graph, where it is clearly depicted, clearly showing the declines in the lines. What the Fed and investors fear, keeping them up at night, is whether there will be a resurgence during the year if Trump imposes tariffs or if there is a flare-up in the Middle East. Producer Price Index. This measures the average change over time in the selling prices received by domestic producers for their output, indicating inflation at the wholesale level. In the graph, we see how the P for the United States and we observe exactly this gradual decline in inflation. Both the CPI and the PPI are indicators that show us how inflation is trending. Central banks take them into account to determine their monetary policy. I made a video in 2021 when inflation started to rise and there was this concern in the markets, in which I presented a strategy to make money from inflation. You can refer to that video to learn more. But we've covered the theoretical part well up to this point. As investors, what do you need to know about these indicators to adjust your portfolios? In the United States, inflation is projected to decrease from 4.1% in 2024 to 2.9% in 2025. In the European Union, inflation is expected to remain above the European Central Bank's 2% target. Let's now look at which factors will influence the recovery. First and foremost are Trump's tariffs. Tariffs on imports can lead to higher prices for consumer goods, increasing the consumer price index. Producers facing higher input costs will pass them on to consumers, affecting the index. Subsequently, geopolitical events, such as conflicts or sanctions, can disrupt supply chains, leading to shortages and higher prices, thereby increasing both the consumer price index and the producer price index. Additionally, a stronger dollar makes imports cheaper, which can contribute to lowering the consumer price index, reducing the cost of imported goods as well. Moreover, the monetary policy of central banks clearly affects inflation. Lower interest rates can stimulate demand, potentially leading to higher prices, and an increase in the consumer price index if supply does not keep pace. Finally, rising oil prices, increased transportation, and production costs, which can raise both the consumer price index and the producer price index, as these costs are passed through the supply chain. On the channel, I provide tons of free content about investments and the stock market. However, for anyone who wants to delve deeper and learn more, we have several online seminars on our page about investments, which you can find in the video description under our products. Content about investments and the stock market. Next, let's move on to the unemployment rate. The unemployment rate measures the percentage of the labor force that is active and actively seeking work. A lower rate indicates a strong job market, while a higher rate signals potential economic weakness. In the United States, the job market is strong, but as we can see in the graph, there are signs of fatigue. It is important for unemployment to remain at low levels, and as we mentioned at the beginning of the video, it is one of the two goals of central banks. For 2025 in the U.S., the unemployment rate is expected to slightly increase to 4.3% from 3.6% in 2024. This small increase is not concerning, as unemployment in the U.S. is at historically low levels. In the European Union, labor markets are facing uncertainties, with a potential increase in unemployment due to economic stagnation. Let's not forget that recently, the automotive industry in Germany, which is one of the largest employers, is under pressure. Even the economy of Greece is fragile, mainly due to our economy's large exposure to tourism. Tourism is a very cyclical sector, and it is directly affected by economic and geopolitical developments. But what are the impacts on economic growth? The increase in the unemployment rate in the United States suggests that job creation is slowing down, which could reduce consumer spending. In the European Union, high unemployment could weaken demand, further slowing economic growth. As we mentioned at the beginning of the video, one of the variables of GDP is private consumption. Therefore, as unemployment increases, private consumption decreases. Thus, GDP slows down. Next, let's look at retail sales. Retail sales measure the total receipts of retail stores, reflecting consumer spending trends. They are a key indicator of economic health, as consumer spending makes up a significant part of GDP. The graph depicts retail sales in the USA, and we observe signs of a slowdown. Let's take a look at the estimates and forecasts for 2025 now. In the United States, retail sales are expected to strengthen, as lower interest rates encourage consumer spending. In the European Union, consumer spending remains weak due to inflationary pressures and economic uncertainty. Stronger retail sales in the United States could support GDP growth, while weak retail activity in the European Union may signal ongoing economic stagnation. Next, we move on to markets and investment trends. Investors are now operating in a new reality, where stock performance is not solely based on artificial support from central banks. In financial journalism, the technical support of central banks for stocks is referred to as the Fed's put. What does this mean? Because every major stock market drop, that is, every market meltdown, leads to an economic crisis. Thus, for example, the Federal Reserve of the United States intervenes with statements or by printing money or buying bonds in order to stabilize the markets. For 2025, the technology and healthcare sectors are expected to continue their upward trajectory, with stocks like Vertiv Holdings, GE Vernova, Rocket Lab USA, Robinhood Markets, and Reddit attracting interest. At the same time, the dividend stock sector, and especially real estate investment trusts, by author wave, such as Vici and MPC, offer stable returns for those seeking passive income. Moreover, as the Fed lowers interest rates, stocks in the rates sector will see an improvement in their valuations and revenues. And this is because rates, in order to expand their activities, have significant exposure to borrowing. So, the reduction in interest rates will improve their balance sheets and profitability. Because lower interest rates mean reduced expenses for interest repayment. Subsequently, technology will be a catalyst for economic growth, with artificial intelligence, the space industry, and renewable energy sources taking a leading role. Businesses that invest in innovation will have a competitive advantage. The new president of the United States, Donald Trump, announced the Stargate project with a budget of $500 billion in order for the U.S. to be a leader and have supremacy in artificial intelligence. Since the cycle of interest rate hikes began, also known as monetary tightening, the investment activity of businesses has generally been weaker. However, since the end of 2024, major tech companies have significantly increased their capital expenditures for investments in artificial intelligence and data centers. Also, according to corporate earnings announcements, for the fourth quarter of 2024, most major companies announced an increase in capital expenditures for 2025. This enhances the prospect of technological development and can act as a driving force for the economy. A factor that will positively affect businesses is the deregulation promised by Trump, which will lead to an increase in mergers and acquisitions activity. This will lead to vertical integration of production and strategic alignments. What I suggest you follow as investors for 2025 based on the above is to focus on the following short-term investment products for protection against interest rate fluctuations and to ensure a steady income. Large-cap companies with stable profitability to avoid market volatility, especially until mid-2025. I estimate that we will experience significant market volatility, with large drops followed by rapid rises. And finally, technology and artificial intelligence, as the investment by major tech giants in data centers and AI continues unabated. At the same time, we observe that both medium-sized businesses and consumers are turning to the use of AI even for everyday applications. As artificial intelligence matures and people become more familiar with its use, the more it will be adopted. Additionally, data centers and their infrastructures will experience growth. The next thing we will see is geopolitical developments and risks. Here, I will mention as an example how I made 18,000 euros in 4 months from stock trading. I have made a video on the channel where I show you the results and analyze the strategy one followed to achieve this profit. In short, what I did was closely monitor developments, and, having knowledge of geopolitical risks, I used this knowledge to make money. So, if you study what I present to you in this video and are familiar with the market, macroeconomic indicators, and geopolitical risks, you can use them as tools to make money. This shows you, in other words, how you can make money even during a downturn. When all indicators and stock markets have fallen, the strategy one mentioned and present in more detail in that video is just one way you can profit from a downturn. In the last decade, we have been led into a multipolar world. After the collapse of the Soviet Union in 1991, the United States and its allies, what we call the Western world, were the only players on the global stage. The economic, technological, and military dominance of the West was indisputable. In the last 10 years, we have seen the emergence of new players and regional powers. The main geopolitical rival of the United States is China, and that's why we see the gradual shift of forces from the Middle East and Europe with the aim of strengthening the Indo-Pacific. This was sealed with the AUKUS agreement signed on September 15, 2021, by the countries of the so-called Anglo-Saxon Axis, the United States, the United Kingdom, and Australia, which provides for the collaboration of the aforementioned countries in military and technological levels. The objective of AUKUS is to counter the ever-increasing influence of China in the Indo-Pacific. At the same time, we have the emergence of regional powers that act destabilizingly on the geopolitical chessboard, exhibiting imperial ambitions. An example of such powers is Turkey, which threatens the southeastern flank of Europe, the Middle East, and North Africa with destabilization. Do not forget the support for the illegal regime in Libya, the Turkey-Libya Memorandum, and the support for Haris Talani's in Syria. Iran has long-standing geopolitical ambitions, dating back to the era of Cyrus the Great, to have access to the Mediterranean. In order to achieve this, it funds extremist organizations such as Hamas, Hezbollah, and the Houthis in Yemen. These organizations are known as the Axis of Resistance. Let us recall at this point the significant problem caused to supply chains by the Houthi attacks in the Red Sea, which resulted in affecting ship freight rates and supply chains. Geopolitical tensions, the war in Ukraine, tensions in the Middle East and Asia, will continue to affect the energy market, supply chains, and investment sentiment. Any turmoil can lead to price increases in raw materials and new inflationary waves. The geopolitical tensions that will play a significant role in the economy in 2025 and that we need to keep in mind. Ukraine. The continuation of the war will keep energy markets unstable, especially the European Union's dependence on liquefied natural gas has created increased costs for energy-intensive industries. This has led many industries to move part of their production to other countries, leading Europe towards deindustrialization. South China Sea, China, Taiwan. China views Taiwan as a breakaway province. From this perspective, it has aspirations to annex Taiwan, even by force if necessary. In recent years, tensions in the region have escalated. China has increased military exercises and the overflights of armed fighter jets. In Taiwan, the largest percentage of semiconductors is produced in the factories of Taiwan Semiconductor Manufacturing Company Limited, whose shares are traded on the New York Stock Exchange under the ticker symbol TSM, are vital for technology companies. A heated incident could cause extreme disruptions in the supply chain of technological products. Even the threat of an invasion or a heated incident will lead to a drop in stock prices. Middle East. Instability in Iran and tensions with Israel could drive oil prices above $100 per barrel. The war between Israel and Hamas, as well as the fronts with Hezbollah in Lebanon, we do not know how they will develop. In any case, the price of oil is entirely dependent on geopolitical movements in the Middle East. Let's look at some scenarios in the Middle East and how they will affect the price of oil. Scenario 1 is stability. If there are no serious geopolitical upheavals in the Middle East, oil will range between $75 to $85. Scenario 2 is an increase in tension in the East. Prices could skyrocket above $100, putting pressure on inflation. As we mentioned at the beginning of the video, economies and production are directly linked to fossil fuels, and any increase in the price of oil will lead to a rise in inflation. In the online seminar Investments and Trading for Beginners, there is a whole lesson on the G. Next, we have Trump's tariffs on Canada, China, Mexico, and the European Union. Donald Trump was elected with the slogans, America First and Make America Great Again. In his effort to repatriate part of the industrial production and reduce the trade deficit, he has announced a series of tariffs on third countries. More specifically, he has threatened to impose 10% tariffs on imports from China, 25% on imports from Mexico and Canada, and has also threatened the European Union with tariffs. Many analysts point out that he is doing this in order to bring these countries to the negotiating table. The purpose of the negotiations will be to demand concessions from these countries in order not to impose tariffs. According to the latest data, we have the following scenarios regarding the tariffs. The first scenario is the maintenance of tariffs on Chinese imports. According to analysts, the 10% tariffs on Chinese imports are likely to remain, which could lead to price increases and inflationary pressures in the U.S. If China continues to retaliate with its own tariffs, there might be an escalation, affecting not only the markets but also global supply chains. Next, we have the second scenario, which is negotiations with Canada and Mexico. The imposition of 25% tariffs on goods from Canada and Mexico could be avoided due to the negative impacts on American consumers, particularly in food and the automotive industry. According to analysts, it is most likely that Trump is using these threats as a negotiating lever to achieve his objective. This environment makes 2025 a year full of uncertainty, where investors will need to quickly adapt to new conditions. In any case, if we have a trade war, the most harmed is not the consumer. Even Donald Trump has admitted that tariffs might have a negative impact on the American consumer. In the event of a generalized trade war, we will see a resurgence of inflation and a decline in corporate profits. Reduced corporate profits will affect the financial valuations of stocks. As we have mentioned in previous videos, the stock price on the stock exchange board is a reflection of investors' expectations for future profits. The everything bubble. Stock markets are directly linked to macroeconomic data. They are affected and communicate like interconnected vessels. A drop in macroeconomic indicators affects the stock markets, and a significant drop in the stock markets leads to a drop in macroeconomic indicators and into a recession. Since 2020, the prices of real estate, stock indices, and cryptocurrencies have skyrocketed. Many analysts believe that we are in the everything bubble. But do you know when you realize a bubble is bursting? When you hear the pop. However, 2025 requires caution, as many opportunities will also arise. As we've said, the best period for wealth accumulation is when everything falls. Markets are approaching the historical high levels of speculation we saw in 2021, when there was a bubble-filled market due to the pandemic and the money printed by central banks. If you remember back then, money from stocks and cryptocurrencies. Everyone was making money. My estimation is that the current market situation is very reminiscent of the 2021 market, which was the most speculative period we've ever seen. Back then, we had the bubble of the SPACs, the electric vehicles, the cannabis stocks, the height stocks. Now we have the AI stocks, space stocks, quantum computing. There are similarities, so caution is needed. I also point out the rise of new meme coins in the market as an indication of speculative mania, with the example of Trump coins that was introduced the weekend before Donald Trump's arraignment. The issuance of meme coins is a characteristic example of speculation in the markets. In recent months, we have observed a surge in IPOs and the creation of many meme coins. At the same time, the stock market is also showing bubble tendencies. One indication is the increase in IPOs. Even on the Athens Stock Exchange, we are seeing the introduction of new companies. According to analysts' estimates, 2025 will be the year when we will see increased IPOs in the stock markets. And many companies will attempt to enter the stock markets. This indicates a trend of bubble formation, in the sense that many companies doing IPOs are doing so to offload shares or insiders, taking advantage of market height and high valuations. Therefore, be cautious with speculative investments. According to the Warren Buffett indicator, the U.S. stock market is considered overvalued. What is the Warren Buffett indicator? It is an indicator by Warren Buffett that determines if a stock market is overvalued or undervalued. It is the ratio of the total stock market value to the country's GDP. If we put the numbers into the above ratio, we find that the indicator is 208%. This ratio fluctuates over time, as the stock market value can be very volatile, but GDP tends to increase much more predictably. The current indicator of 208% is approximately 66.62 or about 2.2 standard deviations above the historical trend line, indicating that the stock market is significantly overvalued relative to GDP. Why does this matter? The Buffett indicator expresses the value of the American stock market in relation to the size of the American economy. If the value of the stock market increases much faster than the real economy, then it may be in a bubble. In the coming months, there are several risks threatening the market, such as the political theater in the U.S. and Trump's economic agenda, which includes high tariffs and significant job cuts in the public sector. Additionally, there are risks from disruptive technologies that could shock the markets. Recently, a Chinese startup made an impression by causing a $1 trillion drop in January stocks. This happened after the presentation of an AI model, which seemed to compete with ChatGPT using cheaper and older technologies. Processors. Technology, like artificial intelligence, carries the risk of being overturned itself. What do I mean by that? Technology companies, especially those in the AI sector, are valued with price-to-earnings ratio that values them with growth rates of 30 to 40%. Next, let's look at the prospects for 2025. Based on the above analysis, we observe that 2025 will be a year of challenges but also opportunities. Initially, the fact that we have entered a path of monetary easing by central banks means steady growth. For the economies, the thorns for growth are persistent inflation and the potential tariffs that might be imposed by the President of the United States. Furthermore, there is positive momentum in business investments to adapt to the demands of the AI era and increased usage. Data centers. Therefore, we will see an increase in the valuations of many AI-related stocks with data centers and infrastructure projects that support them. Furthermore, the geopolitical landscape is fluid, and the United States and the West will need to make significant military investments to maintain their leadership. At the same time, the next battle will be for securing vital space in space. And for this reason, I believe that companies active in space will see an increase in their revenues. Through the increase in government contracts, let's take a look at a recommended investment strategy for 2025, how to navigate a market reminiscent of 2021. 2025 requires caution, but at the same time, many opportunities will also arise. The market is overvalued, as we can clearly see from the Warren Buffett indicator, which is at 208%, far exceeding historical levels. At the same time, we are witnessing speculative mania in AI stocks, space stocks, quantum computing, and in crypto, meme coins are popping up everywhere out of nowhere. IPOs are increasing, which indicates that insiders are trying to offload stocks at high valuations. In such conditions, the strategy should be conservative, yet flexible. We don't buy everything that shines, but we target value, defensive sectors, and maintain liquidity to take advantage of possible downturns. Let's first look at stocks. Under the current conditions, would maintain a flexible aggressive strategy. So, a recommended aggressive strategy is to have 50 to 60% of your portfolio in stocks. My motto for the current semester is targeted moves, not hype. Initially, a large portion of my stocks are in defensive investments and value stocks. When the market is at its peak, it's good for investors to look for safety and liquidity. Defensive stocks will benefit from increased geopolitical tension and military spending. Also, stocks related to utilities and infrastructure will see revenue growth due to data centers. At the same time, stocks with stable dividends from the consumer staples sector will ensure a steady cash flow. Examples of such stocks are Lockheed Martin, Northrop Grumman, Raytheon, which are from the defense industry sector, with stable government contracts. Then we have Brookfield Infrastructure, Nextra Energy, Duke Energy, Vertiv Holdings, where we have infrastructure, energy, stable income. And then for the dividend investment enthusiasts, we have PepsiCo, Procter & Gamble, Johnson & Johnson, which are stocks with stable dividends. Next, you can have targeted exposure to technology. AI brings opportunities, but we don't go for the first names that will burst when the bubble pops. We focus on companies with real value. Some examples are Supermicrocomputer, NVIDIA, which I have also analyzed. I've made a video about its analysis, Broadcom, where we talk about AI hardware and data centers companies. Next, we have Rocket Lab, Boeing, KLA, which are in space AI-driven, data analysis, defense contracts. And finally, we have CrowdStrike Fortinet, where we have cybersecurity, AI network protection. What do we observe here? Axes and shovels. We don't go for the hype, we go for the infrastructure. What helps AI? What AI relies on? These are some examples. So be careful. What do we avoid? Hype. No hype stocks, no new IPOs, no meme stocks like GME and AMC that we had in the past. It's also important to have liquidity of 10 to 20% in cash or short-term bonds and acquisitions. And this leads us to bonds, where you can have 20 to 30% in bonds to invest smartly with the interest rates. If the Fed were to ease monetary policy, bonds would perform better. We don't go all in, but we maintain a significant percentage for stable income and risk hedging. Let's take a detailed look at which bonds you could invest in. U.S. Treasury bills, 1 to 3 years. Low risk, decent returns. Next, U.S. Treasury bonds, 5 years. 10 years. Provide protection in case of a recession. Then, investment-grade corporate bonds. We have large giants and stable returns. And then, inflation-protected, hedging against inflation. At the same time, you can also invest in mortgage-backed securities, which are packages of mortgage loans. And currently, they have returns higher than the average. 10% year-over-year of the S&P 500. Additionally, we have a very detailed course on MBS in the Investment and Trading Bible. And then we move on to talk about cryptocurrencies in the current geopolitical conditions. It is recommended to have 10 to 15% of your portfolio in crypto. Be careful, again. What did we say? No meme coins, only projects with substance, with utility. The cryptocurrency market is moving in speculative mania. We see ICO, scams. We see meme coins popping up, but we don't fall into these traps. A recommended strategy is to invest 70 to 80% of the crypto portfolio in these 3 cryptocurrencies. Bitcoin, what can we say here? There's no need to say anything. It has now established its value. We're talking about digital gold, a hedge against monetary policy. Next, we have Ethereum. Similarly, it has great utility because it serves as a fundamental infrastructure for DeFi and AI applications. And a third option is Solana, which offers fast transactions and has a large community. Next, an experimental capital of about 20 to 30% of your crypto portfolio could be invested in speculative crypto. Here we're talking about be careful, high risk, greater risk. Let's look at 3 suggestions. AI can defy tokens, fetch. AI, render. Singularity, net. Then we have the gaming and metaverse sector. The metaverse presents exceptional interest. We are watching it with interest where we have Immutable X and Gala Games. And then, Layer 2 scaling solutions, Arbitrum and Optimism. Attention, what do we avoid? Meme coins, new, ICOs, low-cap projects that rely solely on hype. Social media influencers. So, the final strategy, how do we proceed? First, we reevaluate the portfolio every quarter. If the market sentiment changes, we adapt. Next, we maintain high liquidity to buy when stocks fall. We also avoid bubbles. We don't buy whatever influencers and social media promote. Finally, we diversify the portfolio into stocks, bonds, and cryptocurrencies with a balanced allocation. The year 2025 will have challenges, with the economy moving between uncertainty and dynamic developments. At the same time, there will be great opportunities for those who have liquidity and strategic thinking. As we mentioned at the beginning, the best time to get rich is when everything is falling. We don't follow the hype, we invest with a plan. As investors, you must closely monitor the actions of central banks, geopolitical developments, and technological advancements, adjusting your strategies accordingly.